Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. Joel, great to be able to catch up with you. Certainly a lot going in the market today. We can see your screens in the background. Do what you need to do. So, and for our viewers, they know, of course, you're the institutional tech and media trader at Wedbush Securities. So the institutional perspective is what we're bringing people today. So thank you. And with that, why don't we just start in terms of what have you been seeing in the market over the past couple of days in terms of some of the tech heavy selling?
Yeah, I mean, it obviously yesterday was obviously a very ugly day for tech and growth overall, but it seems like obviously tech's underperformed for a while. If you go back to even the early February, both the Nasdaq, the Qs, some of the growth baskets of stocks have just massively underperformed the market. And really, stating the obvious, the number one driver has just been huge sector rotational forces. We know when COVID was going to I guess it's never going to go away potentially, but the focus of the market's been on vaccine progression, reopening process, and return to normalcy, and that's obviously benefited the value trade, which underperformed on a multi-year basis, really for the past decade plus. But their inflationary pressures are picking up in different aspects of the economy, and that's kind of what's been the number one driver of this big rotation. So that's really the stating the obvious. And then under the hood with tech, it's been just the consistent issues. There's 4 or 5 things. So I mentioned rotation into energy and financials that have difficult comps, fading COVID tailwinds, which were so prevalent pretty much all of 2020, rising yields and inflation angst. And that's really crowded position. Tech has still been overweight for majority of portfolio managers, for a decade plus. And then you get in this environment, a lot of these guys running money have never experienced what we're seeing right now. Obviously, we had 2020 was bizarre to say the least. We plunged into a recession very, very quickly, almost at the flip of a switch. And then it's almost like the recovery trade almost started, the market was, recovered that 20% pullback, whatever it was, within a month, I think it was by last April. So it's a very bizarre time. Last year was just growth, pro-growth, risk on. And now it's obviously the forces are shifting and tech managers are being left behind and struggling, to say the least. It's been a painful year for a lot of the growth funds.
But I guess a couple of things though, Joel, and I wonder, can't some of these tech names just continue to work? I mean, obviously, you always see a lot of selling pressure in the entire group. It's hard to be kind of the standout company that doesn't fall for that.
Yeah.
But my question, I suppose, is, there are secular winners as well with some of those tech companies, but what's the key driver to tech selling off? Is it truly just, a money flow rotation aspect? Or what are tech stocks incorporating or assuming as it relates to, the inflation that might be picking up? Are they thinking, are tech investors thinking that that inflation is going to be run away and that the Fed's going to actually have to really raise rates? What's the thinking among the tech hedge community?
That's kind of the $1 million question right now. Will Powell actually act? Will he, give in? Some people say the data is more mixed than some of the headlines we'll read. But yeah, it's kind of it's an interesting. You highlighted it clearly. There's a lot of secular winners coming out of COVID, heading into a post-COVID world. We know that digital transformation, the shift to the cloud, those type of AI, 5G, they're not going to slow down anytime soon. The problem is that a lot of that demand that was slated for, say, 2021, 2022, and maybe even a little bit further out, was all pulled forward in 2020. I know Microsoft CEO, Nadella, I don't know what quarter it was. It may have been June or the September quarter conference call. He said, they've seen 2 to 3 years of demand pulled forward. So that kind of plays in the whole thing, fading COVID tailwinds. eventually, I mean, you're not going to see the tailwind, the spending remain that elevated for on a multi-year basis. So now you have, you know, difficult comp, signs of deceleration, which again, when you're a growth investor, especially in tech where you had valuations just get really out of control, you know, any signs of deceleration are just red flags. And
Mm-hmm.
I think you look at some of the black swan events we've seen so far in 2021. I mean, this year feels like it's been 3 years, you know, tucked into 5 months or 4 months, God, 4.5 months. I mean, the Reddit fiasco in late January with GameStop and a slew of other names. Then you had the, you know, the Billy Wang and the Arcados blow up, family office blow up, you know, in March. And you looked at his positions. There were obviously Chinese internet and then a couple, you know, U.S. media streaming names, Viacom and Discovery. And it just really, they all lead to tech. I mean, everything kind of focused to tech. You know, when the Reddit names, it was GameStop, obviously a lot of tech and consumer PMs were short that stock. AMC Theaters, obviously a media name. BlackBerry got caught up in it. Nokia. And so it's almost becoming, tech being so popular, it's also fallen victim as an after as a result to some of these, you know, retail frenzy, the meme stocks. They all fall under that TMT umbrella. And then look at the SPACs too, the SPAC implosions. You know, EV names are really at the forefront of this, and now with the SEC cracking down on that whole kind of on that racket, won't call it racket, call it a game. You know, that's just left a lot of, you know, retail guys holding the bag, and it's just created a lot of uncertainty. But it seems like tech has taken the brunt of all these odd events. And I think, you know, not even looking back, we knew in January something odd was afoot. Even not just the Reddit, something was off. You know, even to look back to last year, we had the DoorDash IPO, the Airbnb, AI, which is Tom Siegel's AI company, C3. I mean, these companies were debuting at 100 times sales.
Right.
It's staggering. You know, I look at it, you know, Nvidia was say trading at 40 times EPS, and people were like, that's an insane multiple. You cross over into some of the software names, they were trading at 40 to 50 plus sales, which kind of speaks to the insanity. And hence there was a lot of caution from a lot of people, but clearly momentum, quants, and retail were piling into these same group of stocks, and momentum goes the other way, and here we are. You know, in mid-May, tech's been battered. People don't really know what to do. And then you have the Kathy Wood element of it all. She has a cult following. She had a really good interview, depending which side of the trade you're on with her. Good interview on CNBC on Friday. Definitely worth checking out, and it's head scratching. Can't deny how ahead of the curve she was in her view of disruptive tech. She was obviously an early investor in Tesla, but then you find out, you know, weird things are popping up here with her. Like Billy Wang was an early seeder of her funds. That's kind of it's an odd connection there. And then her saying, you know what, I really love this setup when her stocks, her funds 35% off the ties. I mean, doesn't make any sense, right? It just on any level, any manager running money, you don't want to hear him say, I love this setup. And then the fact that she's been averaging down in all the losers, Skills, Palantir, you know, and the list goes on, Teladoc, Square, Roku. And it's a very bizarre philosophy. So that's kind of what I've been watching on a daily basis. It's the ARK price action of ARK ETF. And then today we're seeing a big reversal. Closing the highs is definitely a near-term positive. But like, again, up until, you know, really until something changes, you're definitely seeing rallies sold in the growth complex versus dips being bought. And buying the dips worked every day pretty much in 2020. And that strategy has been failing miserably.
Failing miserably, but what are we even seeing today? Not to be so, you know, minute by minute, but, you know, you are an institutional trader. It seems as though there is some support.
Yeah, I mean, today we'll see how it shakes out. And there's definitely been I've seen some smart money guys nibbling in stocks that have nearly more than halved off their highs. So there's definitely some increasingly interesting opportunities. What I'm seeing is more is at least the tech dedicated guys are more gravitating towards the large cap names, which versus some of the higher flying kind of, you know, stocks under the tech umbrella. Names like, you know, ServiceNow had a really bullish analyst day yesterday. Adobe, Microsoft. So still more guys are gravitating towards the more defensive names in the portfolio. Activision, they had probably the best, you know, earnings of all the video game publishers. And we've been seeing dip buyers of that stock. They actually caught an upgrade today at BMO. But But again, that I would consider that a more defensive name within tech, and
Yeah.
software complex. So like again, I'm not all the demand I've seen in Palantir, AI, mostly it's been just hedge funds covering their short positions.
Okay. How do you see? I want to actually go through a couple of sectors here. Give us the latest in terms of what's going on in the semicap equipment space.
Yeah, I mean the SOX is probably only 10% off its highs. Give or take kind of 100 or 200 basis points. I know I'm around the ballpark there. Very crowded. Here's a group of stocks where they came into earnings season. Everybody knew the fundamentals were going to be solid. The conference calls are going to be very bullish. We know about the global supply chain issues that continue to kind of plague the group. The number one headache here for the semiconductor companies is that everyone knew that the earnings were going to be good. The conference calls are going to be extremely bullish on the secular trends. But with this, the difference is, we know pricing's been going higher. Supply tightness is going to probably linger well into 2022. But that has also created some fears of double ordering, as a lot of customers are just scrambling to get their hands on any sort of supply. So they're just ordering as much as they can. And obviously there's not enough capacity out there to keep up with it. But if that end market demand never materializes, then there you go. Then we're faced with a chip glut and an oversupply issue. So it can flip. That's kind of what people were kind of been weighing on the semis the past 3 or 4 weeks. Fear of double ordering, peak cycle, and where do we go from here? Personally, I think it's probably double ordering. There's no indication of that. Microchip told us that last week. They said they're still seeing, supply demand remains very favorable. Pricing's headed higher. And again, they said we're not seeing any signs of double ordering. So that was definitely a bullish indicator for the chips that we haven't seen in quite some time. But yeah, that's kind of what's going on for the semis. I still personally prefer the equipment names. We know that the United States, the EU, China is still going to kind of continue to invest in semiconductor production and manufacturing. And that's going to be a multi-year basis, and not 2 or 3 years. That's a decade probably, plus. And then obviously Intel's under Gelsinger's made a new, manufacturing IDM 2.0. That's obviously his big strategy to kind of turn the ship there. So I think the tailwinds for the equipment vendors has a much longer tail than some of the names underneath the hood.
So the semicap equipment names, top 3 would be what?
An evaluation point of view, AMAT's probably one of the cheapest, and they're a front end supplier, so they tend to see demands quicker than some of the other players. But it is cheaper than Lam Research and Clack, so that's my top pick there. And then obviously more from just given their monopolistic position is ASML, based in Europe, and they supply all the really high end leading edge tools. They cost hundreds of millions of dollars. But again, anytime you really look at what Taiwan Semi is saying, it's for the most part they're focused on 5 nanometer, then it's going to go down to 3 nanometer, and that's kind of where it's called EUV, which is that's kind of the technology. And Samsung's been very vocal in late April about their commitment to EUV investments as well. So to me, ASML is very well positioned as a long-term growth play. If you can stomach some of the cycles like we're seeing right now, it's not gonna burn you. And if it does fall 20%, hopefully maybe keep a little bit of dry powder on the sidelines for that day, because it'd be a gift.
What do you think though of the AMDs and the Nvidias of the world though right now? And when we think about inventory issues, that can always be a huge headwind if in fact they come to fruition. So what is your view in terms of whether, are you in the same camp as Microchip CEO in terms of any kind of inventory glut, supply glut, or which would be hard to believe given the shortage?
Yeah. I mean, that's the thing, but that's how quickly. I mean, I think I think Citigroup had a negative call today on AMD and Intel. I'm yet to fully read it, but I know part of the negative semi thesis of late has also been because of all that work from home capacity that was added in 2020. I think PC sales were at was the best year in a decade for PCs. We know handset demand was strength. Just look at what iPhone's been doing. Monitors up and down, consumer electronics is a very strong year with people at home. Clearly, when the world starts to reopen, demand it potentially could fall off the cliff in the second half of 21. So that is adding to the whole supply glut fears. it's more of a looking out into the second half of this year, not really in the near term. But again, so if you have all these companies ramping up their ordering, so they can meet demand, and then obviously capacity is running at 100%. Or what if consumer demand doesn't live up to those expectations, which, like some of the COVID story stocks, you have to think that the second half is going to be a lot weaker than we saw, year from a year perspective.
Mm-hmm. It's amazing how, within your financial model, you got to add in a COVID-19 line.
Yeah.
Yeah. And understand the timing of it and the impact. But when you think about Nvidia as well, though, like that's a company that has other exposure other than just kind of the work from home. 5G is an example. Like how are the big tech guys really looking at it?
Yeah, I mean, in Nvidia, I keep them in my FANG man category. So that's, what is that, 7 companies. Yeah, Nvidia is about like 10 to 12% off its highs as well, which I don't think it's that dramatic. And I think, we've talked about it before, even probably years ago when maybe Apple was in the midst of a pullback. But I mean, yeah, Nvidia is a leader. I mean, it's a tough name to short outright, because you think there's major headwinds on the horizon, because like you said, they have secular exposure to AI, gaming. They're the leader in gaming as well. They also benefit from the rise in crypto. So that's kind of, if you want to think, is crypto going to be a demand fad like 2018, where it fell off the cliff after the kind of the rise and fall of Bitcoin? And obviously now we're back up in that upswing. To me, with more corporate adoption and more mainstream kind of attention, I think it feels like crypto could be much more of a steady revenue stream for names like, for both AMD and Nvidia and Taiwan Semi, which is bullish. I prefer AMD. And that's just mostly because I think they're still going up. They have an 18-month lead versus Intel and 7 nanometer. And I still think Gelsinger has a long road ahead of them to kind of catch up from all the missteps that Bob Swan made, his previous, the previous CEO of Intel. So that's where I look at AMD is still a fairly straightforward, market share gain story. They're still benefiting from these secular trends. But to me, that's the key to the story, is that their main competitor is Intel, who continues to struggle. So I still would prefer to be long AMD, short Intel. I think that pair trade will continue to work and for the foreseeable future.
Okay. And speaking of FANGs, what do you expect for the FANG group for the remainder of the year?
I remember a time when you had probably the best set of earnings from these companies, other than Netflix, which badly missed, but that's kind of in its own world anyway. I mean, Amazon, Google, Amazon, Alphabet, Facebook, Microsoft, they all just blew it out, and look what the stocks did. I mean, maybe they made Amazon massive double top before rolling right over. Facebook gapped higher, then it's kind of giving all that back. There's just angst. I mean, there's definitely angst, and kind of, but I think end of the day, these are stocks that have just been huge outperformers. Not I even forget about on a year-over-year basis, still going 5-10 years, and the fact that they're still, in my opinion, 5 to 8% is within striking distance of the highs. It still shows that investors want to own these names. You're seeing guys actively trade around them. Maybe they're getting, especially that some of the tech growth funds, as we mentioned before, growth funds are getting battered pretty good this year. So if guys are forced to kind of degross a little bit and raise some cash, those are very easy names to kind of sell. They're liquid, and they can raise a good chunk of cash as well in the same time, just to take down their exposure a little bit. But I mean, from an earnings fundamental point of view, nothing's changed. I mean, they're still the best companies probably on planet Earth. I think Facebook Alphabet and Apple are buying back like $150 billion worth of stock. So that's going to be another kind of supporter for, I think, these large cap growth companies. You want to be buying on the weakness. Alphabet's still my top pick. YouTube momentum continues to fire on all cylinders. The continued recovery in digital advertising. And then from a cloud point of view, they're showing, continued progression and traction as they kind of claw their way, to gaining a little bit of market share from Azure and Amazon Web Services. So Alphabet to me is just it's not crazy expensive, and the catalysts are pretty straightforward. And it's acted, hands down, it's acted the best out of all the major FANG names, which is, to me, reflects very positively. I think it's yeah, it's about 600 basis points off its highs. So I mean, it's
so nothing really.
Yeah, in my opinion, it's a very, very small pullback, and and it obviously drives a lot of media attention, and people want to know if the trade's over. I don't think it's over yet. But again, I don't think if you start nibbling away at some of these names now, you're not going to get burned, moving
Yeah.
24+ months.
Joel, is there any new name that some of the smartest tech guys are looking at these days?
Yeah, that's kind of one of the problems with tech. It's very so it's very incestuous. I think I can't say the word, but it's everyone piled in the semis, and then you get the fears of peak cycle double run, and then they all sell them, and then we've seen it with FANG over the past 10 years as well, and then obviously with the Zoom Medias, the DocuSigns. I think people are looking for stocks that from more of a GARPy perspective, and that's where I think some of the FANG members check the boxes. Facebook, Google aren't crazy expensive, and then you look under the hood at some of the fintech payment names that have maybe underperformed in 2020. That will benefit from the reopening. So Fidelity National Services, the ticker's FIS, was a big laggard for most of 2020. Very disappointing. It's reasonably evaluated, and like I just said, they're going to benefit from the world reopening and brick and mortar stores coming back on, and people just traveling. And they've seen some steady improvements in their merchant segments. So FIS is a name I like. And then kind of other names going further down the software chain. Look at like Pegasystems. It's a smaller cloud kind of, digital robotic, process, company. And then cybersecurity. Once again, here's a group of stocks that they had a huge lift in mid-December on the SolarWinds attack. Well, then what do we get over the weekend? A major pipeline attack in the US, which to me just highlights, these attacks, it's essentially terrorism. Since this is the second major attack against the US on the cyber front, and now today the price action's a lot healthier. I remember looking at the these security stocks in December when that SolarWinds story came out, they all were up for about 2 weeks straight. Then you look at the screen yesterday, I think 30% of my security names were in the green, the rest were lower because of what was going on tape. So I think you want to look at some of these security stocks where they've all pulled back well off their highs, so valuations aren't as crazy as they were. And then you look at other secular trends, which we highlighted earlier in the show: digital transformation, the shift to the cloud. It kind of just reinforces the straightforward thesis that demand for security is going to remain elevated. And so a name like TELUS, I think I may have mentioned that before. It's been kind of stuck in this $30 to $40 range. The ticker's TLS. They have 90% plus exposure to government spend. They have a lockup coming up, so that's kind of about what's kept the lid on it. So I think the lockup's, maybe May 18th. Don't hold me to that date, but maybe keep that name on your radar. TLS. Probably see some guys maybe hedgy shorting into the event, but typically these also kind of tend to mark the bottoms as well. So that's kind of what I'm looking. Names I'm looking for. Just a little bit GARPy, and then other than like Zoom Media, DocuSign. Yeah, if you want to play it for a day trade, right? You saw the futures make a higher low around 10:30. Like, what? I want to get on the Zoom train. Yeah, I think you can play some of those stay-at-home story stocks from a short-term perspective. But as I said, let's hope to God no one's we're not staring at Zooms. At least the kids aren't, right? In school, the Zoom.
I know.
Remote learning and all this stuff and conference calls and things like that. So I just find it hard to believe that some of these stocks come back and that that growth just won't fall off a cliff. And I think that's what we're seeing.
But it doesn't mean. Sorry, go ahead.
No, that's it.
Well, so it doesn't mean though that when you see these major moves in the broader tech markets, we have to understand that and I think this has been the case for well over a year. You got to be really stock specific, and you're indicating that you can be and still do well, but just kind of watch out for I don't know, maybe if you own an ETF that encompasses a lot of the various stocks that we've been talking about, you might do well to really understand a stock or two that you really like and can weather through.
Yeah, it's been tough, I think, for a lot of, like I said, growth to the tech community. I think I was even speaking last week, and I was even, I was pumping up the kind of energy ETF and even the XLF. I'm like, I felt a little bit dirty even,
wow,
thinking about that on a tech segment, but I mean, you look at those. I mean, obviously they both hit 52-week highs yesterday and have faded since. But I mean, the tape is definitely telling us something, that this rotation still has some legs. So that's why I think within the team to universe, you just do want to be more selective. And you're looking back on last year, obviously it's hindsight, but last year was pretty easy. I mean, these stocks almost every day and those dip days were bought aggressively, and you got paid for it. And it's been anything but in 2021. And as Jesse Livermore said, way back when, like, the tape doesn't lie. So the tape is telling us you got to be a lot more selective when it comes to tech investing, at least in the near term. I mean, the catalyst could be, Jay Powell just continues to kind of, stay the course, like he said. So there's obviously a camp that thinks he may get pushed into a corner to act. But I mean, right now he's been kind of echoing the same message that, we've heard mixed messages from other members of the Fed, but he sounds pretty committed to just kind of staying the course with the current, policy in place. And Yellen, obviously, he's going to have the support of Janet Yellen as well. So, that could be the trigger, one of the next Fed meetings when people are expecting more kind of hawkish tone, where he just kind of reiterates, his dovish message, extremely accommodative, policy in place. And that could be the signal for kind of risk on.
Yeah, that's exactly it. That'll be another boost. Just lastly here, and I'll let you get back to your work. What are volumes like though?
Today, they're massive volumes today. So right now, I was looking at the spiders and Qs, the ETFs just before we got on. They were tracking about 200% above the 30-day average.
Wow.
Is that still true? Yeah, they're about 115% above average. Versus 30-day average. And that was another problem with tech leading into really the earnings season. I mean, March and April, really March and probably the first half of April, talking to kind of, buy-side traders, portfolio managers, liquidity felt like it was the worst it had been in years. And again, we kept on just grinding higher on no volume. And so, I mean, it tends to work that way, right? You kind of walk up the stairs, then you fall down the elevator shaft. But I'd say it, so you're definitely seeing the heavy volume on a big reversal today, like today, is pretty positive. Like I said, I'm seeing some guys nibble away in some higher quality names. So, I mean, I'll have some more conversations and try to get some more data and pick up some intel later today. But again, I think the overwhelming theme is stick to quality. So like I said, highlighting like Microsoft, Adobe, ServiceNow, and you kind of, as your cloud plays, look in the security baskets of stock. With semis, I prefer, the equipment names, just because I think the tailwinds are going to be there from a longer term perspective. And Alphabet within the FANG probably remains my number one. And Apple's an interesting one. Obviously, it's blowout numbers across the board, massive buyback. But I mean, talking to the bears and Apple seems to be, well, they guided down in June quarter for negative growth or flat growth. And what are the bulls going to say next year when there's no growth in fiscal year 22? So that's been something to keep an eye with Apple. That's what the bears are spinning. To me, they spin that every 2-3 years. So it's nothing new. But that's kind of what pushback I've been hearing on Apple is, well, they guided down June quarter, sequentially, which they always do. Next year is going to be X growth. So it's going to continue to weigh on the multiple. And Apple was kind of stretched, heading into the earnings report. So that's what the bears are looking at. I'm really kind of neutral on Apple here. Like I said, I think you can generate better alpha in other large cap names. Like I said, Alphabet, ServiceNow, Microsoft. So I'm not really, caught up in Apple too much, but if you are looking at Apple, keep in mind, that's what some of the big tech portfolio managers are talking about. June quarter being down. Next year is going to be no growth. And so the whole thing they're saying is that the sell side kind of manufactured the super cycle headline, that's been what's driving the multiple higher. Big change in anything major.
And just lastly here, you brought up ServiceNow. I'm curious, what's the latest with Snowflake? Because that company management at Snowflake came from ServiceNow.
Yeah. That's good. Okay, good point. Well, I mean, Snowflakes, you put them right into that IPO, the high flying tech IPO basket from last year. I think the stock opened up. You can hold me to this. Don't hold me to this, but I think it priced at like 140 to 150-ish. It opened at 235. It got as high as it definitely touched, I think 400.
Yeah.
And now where is it? It's trading just below $200. And it was
Right. So is
much.
that of interest? Is that of interest to hedge fund guys these days?
I mean, guys are trading it around. I think everyone shorted it and got completely squeezed out on that move to 400. So guys who could stomach it and kind of were able to ride it down have done very well. But it kind of fell right into that camp, like these high flying tech companies trading at 50 to 100 times sales right out of the gate. And it's kind of been a head scratcher. And
Mhm.
I think, it's funny. I remember one of my a tech investment banker that I know, he kind of was a former portfolio manager at a very large hedge fund in the US. And he said to me, at some of these tickers that the retail Reddit crowd is going to love them. So Snowflake, guys love that ticker. AI is the other one. And how true that was when these stocks just went bananas right out of the gates, and where valuations got thrown out because momentum just, retail triggered the quants, momentum's just piled into them. And obviously really didn't end too well for most people, depending on where they got in. But it's been a grim pullback for a lot of these stocks.
Wow.
It
It
doesn't
has.
conversations because people say it's still not that cheap. It's still relatively expensive as well, even though it's 50% off its highs.
Right.
So that kind of
Right.
sums up where tech is at the moment.
Absolutely. Joel, thank you for summing it up for us. So appreciate your views always. It's
Yeah,
amazing.
thanks for having me. I hope it was. I know there's a lot to talk about, to say the least. So I know I was all over the place a little bit, but
No, it's perfect. It's how the market operates and how you think and trade. So it's perfect. So
yeah.
thank you very, very much.
All right. Well, take care.